So has this experience ever happened to you where you're changing the title on a piece of real estate that you own? Maybe that's adding a spouse, or maybe that's adding a beneficiaries a la a ladybird deed, or maybe it's re-registering it over to a trust. But have you ever done that? Have you gotten a weird, marginally official letter in the mail asking you if you want a copy of your deed for a fabulous service fee of $100? Actually, in my case, when I got the letters, one was for $105, one was for $109. But we're going to talk about that and whether it is legitimate or not, whether it's something that you should be doing, along with the fact that on the program this week, you're going to hear us talk a lot about the IRS. Later on the show, we're going to actually talk about the current crackdown, if you will. I guess there's no real other way to describe that as anything but a crackdown in terms of charitable contributions. Got a tax case out of New Mexico that we want to share with you. And if you're inclined to make charitable contributions, you need to listen up on some of the stringent requirements that the IRS is, in fact, or at least according to this tax court decision, enforcing across the board. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Coming to you from the official Nelson Financial Planning Studios from our office in beautiful Winter Park, Florida. If you check us out on YouTube, you get to see the digs, if you will, that are the Nelson Financial Planning Studios. As many of our regular listeners know, we just finished an addition to our building, been in the same location now for well in excess of 30 years. Decided it was time to sort of expand a little bit, seeing how we were having like 2 people per office. So it was perhaps beyond time to get that expansion done. Anyway, when we did it, we added in a fancy-dancy, or at least I think it's fancy-dancy, little studio with all of the big high-tech stuff. We've got a shout-out, of course, to Super Dave, who was very instrumental and helpful in getting us all set up with the latest and greatest cool radio technology. Anyway, my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Speaking of that team, we're going to be joined next week by Rob Field. I don't know if you saw these headlines. We're going to have him on the show to talk about it. Social Security. Rob, obviously, our resident national Social Security advisor here at the office at Nelson Financial Planning, expected to have a pretty big increase in the amount of the cost of living adjustment. So stay tuned for that. Of course, that goes directly into one of the headlines that we saw this past week. Inflation still relatively high. I think there's a lot of folks cheering the fact that, oh, it's not as high. I think anytime inflation's north of 8%, that's a little steep in my opinion. Fortunately, gas prices fueled up on the way to the program, down a little bit. I think this saw that where the average price was dipping below $4, so that's at least good. Talk about a tax on every person, if you will, across the board, because, right, we all need gas for those vehicles, or for most of the vehicles. I understand there's a lot of electric folks out there as well, but for the rest of us, still throwing the gas in the old engine. Nice to see that down under $4 a gallon. Well, speaking of things that happened this past week, of course, we would be remiss not to talk about some of the legislation or the latest legislation that is coming out of Washington. This segment of this program, we're going to talk about the IRS piece. Thanks to the current legislation, IRS obviously looking to get more money in its budget. about $80 billion, all to crack down on taxpayers. Yes, indeed. Sad trombones all around when it comes to that, because when you look at the bill, it's $80 billion to the IRS, estimated that will increase the IRS funding by almost 50% over the course of the next 10 years. They're not all getting it in one shot. It's a gradual increase over the course of the next 10 years. Here's the interesting breakdown of how that 80 billion plays out. About half, or over half, will be for enforcement. So, you know, that definitely got some sad trombones going on for the enforcement side, but there are only 30 billion for operations and technology. And I guess, is this almost a joke? 3 billion of the 80 billion, so if you do the math, it's less than 4%, to taxpayer service. So much on getting your questions answered on what can only be described as a highly complicated and convoluted IRS tax code. No, not getting any amount, well, 4%, 3.75% of the total. That's kind of small, allocated to taxpayer service. At the end of the day, for some perspective, that I don't know that really is the right split, if you will. Now, allegedly, none of the enforcement dollars are going to go to increase audit rates for those that are making less than $400,000. I don't know how they can make that statement, but that's a statement that they are making. Does that mean if I make $399,000, I can just, cheat away and never have to worry about it? I'm not sure how they're saying that, but that's part of the pitch. The good news, to the extent that there is any on this, is one of the things that had been being talked about that really was making folks not nervous, I think, because they were fearful that the IRS was going to somehow track nefarious activities, but more fearful from a privacy perspective. Because one of the things that has been kicked around in Washington is this notion of, well, let's get banks and financial institutions to report account transactions, money in, money out, so that we can see what's happening, and then, in our infinite wisdom as the federal government, decide whether that is money that you should be reporting as income or not. Let us decide that. Okay, and that way, if we have access to all your bank account information, money in, money out, well, then that'll be great. Well, the reality is, fortunately, there was enough people that said, oh, I'm not be terribly comfortable with that one, especially from a privacy perspective. So that piece was omitted. Now, let's contrast that with the reality. The reality is that audit rates have gone down. We're going to give you the stats, and to a certain extent, it is kind of surprising how low those numbers are. So we get the need that the IRS might need some help, probably need more help on the technology side of things more than anything. But we'll get to that after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. On the program, we would be remiss if we weren't talking about the latest legislation coming out of Washington that is going to send a lot more money to the IRS. Over a 50% increase in funding to the IRS over the course of the past 10 years. On this segment on the program, we're going to talk about some of the areas where the IRS is probably going to focus its efforts with those extra dollars. But first, some statistics, as we were getting to in the last segment. The reality is that audit rates have dropped dramatically. The IRS is behind in terms of technology, so it is having difficulty processing. Obviously, COVID and the inability of the IRS to pivot, as well as private companies, to being remote, was quite difficult. And so they fell further and further behind, just not having the technology like a lot of private companies did to be able to sort of pivot successfully, particularly over the course of the past 2 years. But prior to that, there was a continuing decline of audit rates and of staffing. IRS, no different than any other employer out there these days, hard time finding good people. That seems to be the general theme. The reality is, though, that, of course, audit rates had consequently dropped from 2010 to 2019. So that's pre-pandemic. The proportion of the number of audits on those with incomes over 500,000 had dropped from 53,000 down to 14,000. Pretty dramatic. During that period of time, 2010, 2019, staffing at the IRS had decreased by 40%. Again, same issue where you're having issues with trying to find good people. And I guess here's where the conversation takes a turn, and why you have this focus on, okay, we need to fund money to the IRS because there is a tax gap. We all know that there is a tax gap, and that simply is the difference between the taxes that should be being collected and the taxes that are. Oftentimes, and I'm going to go with, I guess, an optimistic view of American society, a lot of times that is just oversight. Like we see when we're preparing tax returns and clients get letters from the IRS, oftentimes it's because they just forgot something, or something didn't quite get reported the way that it should have been. Nothing nefarious, right? Nobody's collecting a paycheck and trying to not report it, because the reality is most of that stuff gets copied to the IRS. So it's really hard to do that even if you wanted to. But some folks in Washington believe that the tax gap, the difference between what's collected versus what should be collected, is over $1 trillion a year. I think that's a pretty high overestimate at the end of the day. But the folks in Washington are using that estimate to sort of justify the spending portion of this latest legislation that has come out of Washington, because they're claiming that, okay, if we send money to the IRS, we're going to get a return on that investment, and consequently that's going to bring more money into the federal government, and then we can use that money in the federal government to give it away to other things that we like or that we prefer, particularly if you're the political party in charge. So, and that's not a statement on Democrats versus Republicans. The reality is they both do it. And so at the end of the day, that's what they are focusing on. But there's definitely some serious reservations beyond just the reservations that we have. The American Institute of CPAs has expressed some reservations about this kind of an approach, and whether there's really this kind of an imbalance between that the amount of money that is getting collected versus the amount of money that should be collected, combined with the fact that when you think about the amount of dollars that have been allocated to the IRS under this legislation, the minimal amount, less than 4% of the total amount that's getting allocated, is going to taxpayer services. I think at the end of the day, most Americans want to pay their taxes fairly and accurately. But the IRS code is, what's it up to, 70,000, 80,000 pages? It's convoluted and difficult to understand. So if you want to ask a question, who is there to ask a question? Less than 4% of this is going to actual taxpayer service. We share the reservations expressed by the American Institute of CPAs and how little of this is going to actually help the taxpayer, particularly when you think about the fact that the IRS is behind by about 17 million returns that they have yet to process. So anyway, that's the backdrop. And so we're going to talk about now some of the ways in which folks need to be aware of where the IRS is probably going to be focusing some of these resources. So we got 5 general areas, and probably there's more than that, but I think there's 5 key areas that merit discussion. So welcome to this segment, of course, on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, also happened to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice. If you want to see what the new Nelson Financial Planning radio studio looks like, well, then you can see that on our YouTube channel. Just go to Nelson Financial Planning, look for Dollars and Cents with Joel Garris, and you will find us. Have any problems locating us? Well, you know how to solve that. Go to our website, Nelson Financial Planning, upper right-hand corner. You'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get directly connected. My name, Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning. So what are those 5 areas where we think a lot of this extra dough that's going to the IRS is going to be put to work? Well, number 1 is the area of what we think of as flow-through entities. Those would be S corporations, and those would be partnerships. And we're going to take a moment and talk a little bit about partnerships in particular, because since 1990, partnerships and partnership income have grown from a total of 5% of total taxpayer income to a total of 35% of taxpayer income. A lot of folks entering into partnerships, they've got partner where they, open up a restaurant, open up a business, things like that. So those partnership returns and the amount of income that's showing in partnership returns is increasing at a dramatic pace over the course of the past 30 odd years, from 5% of revenue, of taxpayer income revenue, to 35%. So often partnerships, S corps, all have a tendency to be sort of layered, right? Owned by a trust, owned by another corporation, things like that. And so anytime you get that layering, you start to raise the appearance of potentially some lack of being able to track down exactly how the money is flowing, right? I mean, the more layers you create, the easier it is to lose track of exactly where the money is going. So obviously, that is one area that we think you will see certainly a high level of stepped up enforcement, particularly given the growth of the amount of partnership income that's getting reflected on taxpayer returns, and also the lack of audits in this particular area. Here are the statistics. In 2018, there were 4 million partnership returns. Total amount audited out of those 4 million was 140 based upon IRS stats. So clearly there would be kind of one of the primary areas where you would expect to see some level of increased enforcement, particularly on the partnership side, to be specific. Number 2, on the capital gains side of things. Now, when we talk about capital gains, we're not talking about capital gains from the sale of a stock, a fund, a bond, or anything like that at a financial institution, because for several years now, financial institutions have been required to report the full details of those types of transactions. Not only the gross proceeds, what you sold that stuff for, but also the cost basis. The difference is what you've got to pay taxes on. And so when you think of the numbers, when you think of capital gains in 2000 and in this year, for example, it's estimated that about 70% of all capital gains appeared on tax returns where income was greater than $1 million or more. And so, as you might well imagine, that is something that is going to get a little bit more attention from the IRS, because you've got the bulk of it concentrated on those high income tax returns. Now, what is it that we're kind of talking about in terms of capital gains? If it's not stocks, bonds, funds that you would have at a financial institution, well, that's other stuff. And we'll get to what that other stuff is after this break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about some of the areas that taxpayers need to be aware of that are most likely going to be under heightened enforcement, heightened audit rates under the latest increase in the funding for the IRS. We talked about the first one, areas of partnership, flow-through entities, basically partnerships, S corps, things like that. We were talking a little bit about capital gains, and in the second category, if you will. And we mean that not necessarily for your traditional sale of stocks, bonds, funds, stuff like that, because that gets reported directly to the IRS. Financial institutions are required to do that and have been required to do that for a few years now. What we're talking about there, though, is things like sale of businesses, right? Sale of a private business, what's the cost basis? Sale of an investment property, what's the cost basis? Sale of any type of asset where the cost basis or the money that you put into it isn't well known and isn't tracked. And I think that's an area where you're going to see that increased level of enforcement focused on as well. So beyond the cost basis, of course, it's important if you're going to choose long-term capital gain treatment that you actually hold it for more than a year. So I think those two areas, particularly when we think about sale of businesses, sale of investment property, things like that, where you're going to have the IRS looking a little bit more closely on the cost basis, because then that number ultimately can shrink or increase the amount of capital gain that you have to report on the tax return. Number 3 is collectibles. So think baseball cards, old cars, antique cars, wine, things like that, right? I mean, there you've got no idea, right, what the cost basis is. There's no real record of that other than what you are able to supply. And remember, if it's collectibles, well, that's taxed at a higher tax rate than capital gains. Collectibles are not considered capital gain items. They're considered collectible items, which subjects them to a much higher tax, typically at 28%. So that's different than the 15% or maybe the 20% in terms of the higher brackets for capital gains. 28 is a lot more than that. So being able to look at an item and classify it as collectible is going to generate more tax revenue. So that probably is the third area where you may see the IRS focus with these enhanced dollars or this increase in its budget that's particularly geared towards increasing enforcement to the disregard of taxpayer service. Number 4, and this is certainly something we've talked about at length in prior programs, is tracking crypto and various cryptocurrencies, right? As we all know, the IRS asked the question, did you buy, sell, exchange, or otherwise dispose of any cryptocurrency during the course of the past year? That is why they asked the question, to get to the details behind it, because one of the quote-unquote appeal of cryptocurrency is that nobody can see who's doing what in terms of the transaction. Well, IRS doesn't like that, because if they can't see it, that means it's money that's getting made and the taxes are not getting paid on it. So the IRS is really digging into this, and we suspect with the additional dollars that they're going to have to enforce, you're going to see more and more of this. Certainly, they're already hot to trot on this particular topic. They've got some court actions, in fact, out there to force various crypto exchanges to disclose information about clients on those exchanges. So expect that to continue. And then lastly, the area of estate and gift transfers. There's a lot of techniques that folks can use out there to legitimately try and manage their estate tax bill, but there's also some various parameters that must be respected. And if you don't respect them, the rules, if you will, of the game, then you might very well find yourself in trouble. So those are the 5 areas that we think a lot of these enforcement dollars are going to find their way towards in terms of enforcement. So if you dabble in any of those 5 areas, you probably want to, going forward, make sure your records are pretty squeaky clean. Those 5, just to recap: flow through entities, S corps, partnerships. Number 2, capital gains, particularly on capital gains where the basis is not reported. So think things like investment property, private companies, things like that. Number 3, collectibles, right? The painting, the antique car, the baseball cards, the wine, collectibles, things like that. Number 4, crypto. That's been an area where you've certainly seen an increase. And then lastly, estate and gift transfer. So that's what the future's probably going to hold in this new, bigger, better, badder IRS. So just be aware of all of that. We'll obviously continue to keep you posted as we see these developments unfold here on Dollars and Cents. We happen to be one of the top 25 financial planning podcasts as well on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So I recently did some changes to my estate planning. My boys are all becoming young adults, and so that transition requires us to kind of rethink some of the things that we had previously planned for when they were young kids. And so consequently, one of those things involved doing some changes on some property that I own. My home here in the Orlando area, and then similarly an investment property that we have over at the beach. So I changed the deed on both of those properties, and in both cases, and we're going to hold up the letters for the YouTube audience, in both of those cases I got these letters, and if you look at the letter themselves, they look pretty official. They've got dates that say that I have to respond by a certain date. They've got everything about my property, the year it was built, the square footage of the lot. One of the letters even has like a little valuation and things like that on it. So, and they've got these little barcode scanner things, and it, you know, one of them's coming out of Tallahassee Property Records, Tallahassee, Florida, is what one of these says. And so you look at it and you're like, okay, well, what on earth is this? And so what the letter is ultimately asking is, it says that there was a change in the property records for the property that you own, and don't you want a copy, an official copy of your deed? And certainly the letters look pretty official. The reality is that at first glance, you think it's, you know, something important. Maybe I should have a copy of my deed, right? Where is the copy of that thing? I know I signed it and gave it to the lawyer, but where did it go? Maybe this is how I get a copy, particularly if it's official, right? Well, the reality is, if you look at the fine print, you will find the following. You got to look hard, okay? But it's there, and it says, both letters say the same thing in the fine print. This service to obtain a copy of your deed or other record of title is not associated with any government entity. You can obtain a copy of your deed or other record of your title from the county recorder in the county where your property is located. So basically, it's saying, hey, we're just trying to steal $100 from you. Because, you know, you could probably go online and just get it. In a lot of cases, if you go to the county registry of deeds, you can print it out for free. So, is this letter a scam? It's as close to a scam as it's going to get, that is for sure. Because there's no reason to pay $100 for something that you can print free offline. So ignore these letters. With that, we'll take a break here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. Just to emphasize what we were talking about in the prior segment, look, if you did something that changes the titling on your deed, you are all but guaranteed to get one of these silly letters. And it looks very official. And if you're not really paying all that close of attention to it, you may very well say, you know what? I do need a copy of my official deed. I do need something official from the government in order to have that and put that in my file cabinet. And the reality is that at the end of the day, it really is about as close to a scam as you get. There's no reason to pay $100 to somebody to print something offline that you could just go online to your local registry of deeds or county property appraiser and just print for yourself. So ignore that stuff. tear it up, throw it away. The reality is, though, that they do a good job at trying to make it look like it's something official, something government related, something that you really should be doing. But the reality is, don't do that in any way, shape, or form. So ignore all of that stuff. So in the program, we've been talking a lot about the IRS. We thought in this particular segment we would sort of wrap that conversation up with a little bit of a conversation about one of the things that the IRS is sort of cracking down on today. Early in the program, we were talking about the areas where we thought the IRS would start to crack down a little bit more, particularly with the extra $80 billion that got thrown its way this past week. The reality is, though, that the IRS is actively engaged in looking at charitable deductions even now. And so we thought we would tell you the story of Albrecht versus the IRS commissioner out of New Mexico, because it does underscore some of the things that you need to be aware of when it comes to your taxes, particularly if you're doing anything marginally out of the ordinary. And you may say, well, I'm not going to do anything out of the ordinary. But the reality is that sometimes there are one-off occurrences that happen in life that do trigger something a little bit more unique on your tax return. And particularly when it comes to charitable giving, right? I would hope that if you're giving a gift to charity, that at the end of the day, you're trying to do it with some good intentions. Well, the best of intentions can be kicked to the curb when in the eyes of the IRS if you are not careful on getting all of the proper documentation. So we're going to tell you the story, but first, welcome to the program, of course. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Today's show is obviously focused on those dollars that are going to the IRS and how you can be aware of making sure that your reporting is as clean as possible, combined with this segment of the program, understanding a little bit more about some of the things that are looked on from a charitable deduction perspective. My name, of course, Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning, where our team of Certified Financial Fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So here's the case. Here's the background, if you will, of this case out of New Mexico. So a woman by the name of Martha Albrecht and her husband, over the course of their lifetime, had amassed a large collection of Native American jewelry and artifacts and things like that. And so in 2014, they donated about 120 items to the Wheelwright Museum of American Studies out in Santa Fe, New Mexico, well-known American Indian institution. And when they did that, of course, rightfully so, the Albrechts claimed a charitable donation deduction of $463,676. Now, there is a limit on what you can claim for a charitable deduction if it's beyond a certain percentage of your income, but you do get to carry that excess amount of that charitable deduction forward for up to 5 years. And so beyond just year one, the Albrechts had a sort of a 5-year deduction working for them. And when they gave the gift, they got a deed of gift detailing the donation. It said that the gift was irrevocable, it was unconditional, it wasn't necessarily any strings attached. But here's the thing. All of that gift and all of that paperwork back from the museum did not have what the law calls a contemporaneous written acknowledgement from the museum explicitly saying whether or not the taxpayer had received goods or services in return for their donation. Very simply, there was just a sentence that was missing in terms of the documentation that the museum had given. Even in this particular case where the taxpayer didn't receive any goods or services for the donation that they provided, that statement needed to be on the documentation prior to the taxpayer filing their return in order to be able to take that charitable deduction. And here's where the story gets kind of crazy. At the end of the day, the museum clearly clarified, granted it was after the fact, that no goods or services were provided in connection with the donation. You know, it's one of those things where if you ever look at the receipts that you get from charitable organizations, you see that statement on there. And a lot of that statement sort of generates itself from tax court cases like this one. So if you do make a donation and you don't see that sentence on there, then you need to make sure that you're going to contact the charitable organization to make sure that that written acknowledgement that you receive no goods and services in return for the donation is on there, and it's got to be on there contemporaneously with the giving of the gift. What's crazy about this is the museum subsequently was like, well, she didn't, and here's documentation, and they, you know, tried to give it after the fact, and it was disallowed. It's crazy when you think about, or at least in my view, it's crazy if you think about the fact that, you know, you've got a taxpayer, they made a donation. Museum incorrectly did not have the proper language on it, but that doesn't change the nature of the gift. It doesn't change the fact that the taxpayer didn't get any goods or services in exchange for the gift. It doesn't change any of that. All that was missing was a sentence on the receipt. And here's the crazy thing, is the judge in the case said, well, yes, we appreciate your good faith effort to comply, but at the end of the day, it did not satisfy the strict requirements that govern, particularly relating to charitable deductions, under the IRS code. Look, folks, these are the things, okay? This is all good intentions, right? I mean, made a donation to the museum, understandably took a deduction for it, rightfully so, didn't over-deduct it, took it out over a 5-year period of time, and at the end of the day, the taxpayer in this particular case lost the entire deduction, the entire charitable deduction, because of the absence at the time of the gift of a sentence on the form. Folks, in my opinion, that is a travesty. When someone does something with every intent to do it and makes a charitable gift to an organization, look, talk to any charitable organization, they're dependent on these donations. Now, granted, charity should have had it on there, okay? No question at all. But when the IRS goes after and pursues that, it makes you stop and think, relative to this case and the fact that we talked about the extra $80 billion, where all of this is heading. So with that thought, we will wrap it up and wish you all a good Sunday. This is Dollars and Cents with Joel Garrison, Nelson Financial Planning.